Hello traders, my name is Frank Paul, one of the mentors at forexmentor.com, and I'd just like to welcome you to this latest installment in our series of Saturday weekly video presentations demonstrating various aspects of the trading method we call Fibonacci Swing Trader. I think soon to be renamed. We got to give it a name that's more representative of the fact that it's entirely scalable, whether for higher level position trades, swing trades, or lower level day trades and scalps. Today we're going to look at an example of the latter, in fact. So on tap for today, what we're trying to convey here is the idea we've talked about a couple times over the last month or so, and that is you don't even have to be a regular member of our FST daily update service to still find value from the work we do. We post tweets on the 26 pairs that we track every day, 5 days a week at Twitter. And not all of those tweets are going to give you trades, obviously. Sometimes we're just telling you, hey, look, this pair is dead in the water. We've been saying that for weeks on dollar yen, for example. That information in itself is quite useful too, because the last thing you want to do is force a trade on a pair that's not really giving you a quality setup. So you can get value from the negative calls where we say stay away. You can get value from the positive calls that we make that say, hey, look, we've got a valid trading bias or maybe even a setup. And among the 26 pairs that we track, there's got to be at least a few tweets every single day that offer some nugget of information that might be useful for your trading. We only specifically reference shorter term trades on our Twitter page. Higher level trades such as swing trades or position trades are left exclusively for our PDF daily update service. But you can still grab lots of ideas for day trades and scalps from this information. What we use to make these calls is a very simple and effective method adapting Dr. Alexander Elder's concept of the triple screen. He uses the force index, and basically the idea here is, as the name suggests, if you've got the same momentum reading on 3 consecutive time frames, you should be good to go to drill down lower and grab an entry point, buying the dips, selling the rallies aligned with that momentum reading. We don't use the force index. We use stochastics, and in fact increasingly moving towards the same concept, just applying a certain type of Heikin-Ashi bar, again found on 3 consecutive time frames. So just to let you know where I'm coming from as your presenter here, my own trading style is moving towards an indicatorless kind of chart layout, and you might think that that's just impossible, but I'm actually finding if I just focus exclusively on the momentum reading conveyed by Heikin-Ashi bars within this triple screen concept, of course paying lots of attention to support resistance, it can be powerful. And one thing that you probably have learned or are learning, depending on where you're at with your own trading development, is that the fewer indicators you can get by with, the better, because the more clutter you have on your charts, the more there is to look at, the more conflicting signals there are, the more things there are to be confused by. And the problem with indicators is that they all lag. Even stochastics, which is deemed by some to be a leading indicator, it does lag when you compare it to actual price action. It has to lag. Otherwise, how can it calculate from price data and say that a turn is underway? An indicator by definition must lag. Okay, but anyway, we can get around that and still be positioning ourselves for nice little trades, grabbing anywhere from 50 to 80% of the available run, even with lagging indicators, by applying this triple screen concept. And that's what we're really going for when we talk about a specific day trade or position trade or swing trade or scalp bias, whichever. Now, if you followed our Twitter page, we talk about double screen, so that might sound a little bit confusing here. It's really the same thing. When we say daily 4-hour bearish double screen, we're saying we have the momentum reading lining up the same way in those 2 time frames. Just means drill down to the next lower. So we're still basically applying this triple screen concept. And of course, we'll explain it with some chart examples in just a moment. Now, I'd just like to reference an email I received here from one of our followers. This gentleman, Greg, whose last name I abbreviated, also removed his email address in respect of privacy here. He also happens to be a member of the FST Daily Update service, but doesn't matter. He wasn't specifically using that. He was using our Twitter feed. I'll just read his message here for you. It says, "Hi Frank, I went short on the dollar Swiss pair based on a Twitter message after seeing hiking ashy red bars on the 1-hour chart with stochastics overbought. I didn't wait for a stochastics cross of the 50% line, just on the red bars. A bounce from the 38% Fibonacci from a swing point high of 92.87. Pretty easy when all the pieces of the jigsaw fit. In at 90.72. Out at 89.72. Very nice. I need to check Twitter more often! Exclamation marks aplenty." So I'd just like to thank Greg for taking the time to share his success story here. 100 pips on dollar Swiss on a day trade short. Pretty nice. You don't have to do that too many times in a month to have a pretty good result for yourself. Greg's overview of the trade here is a little bit of shorthand, so to speak. So what we're going to do now is flip into chart mode, and we'll see if we can run this thing down in a little bit more detail. And in the meantime, I'm first going to show you the actual Twitter message, which is now on our page. It's archived. You can see it for yourself, which Greg is referring to, which helped him structure this particular trade.